Hey, this is Sasha. Welcome to another episode on Hungry for Returns, where I answer your trading and investing questions on the stock market or investing in general. If you have a specific question that you want me answered based on my own past successes, failures, and screw-ups, you can submit a question on tradersfly.com and just go to submit a voice question. It's just a lot easier because then you get a video response answer and it's detailed. So let's go to the question today. It's all about calls versus puts and why a lot of times it really doesn't matter. So let's listen up.
Hello, Sasha. My name's Greg. I just had a question on how in calendars you refer to doing puts or calls basically the same. Does that mean they end up with the same result? For example, for Amazon, if I was to do a $1,900 calendar, if I put it in as a call or a put, would I still have the same results, say 2 weeks later? Thanks for taking my question. Appreciate everything you do.
All right. So pretty much, yeah, it is going to be the same. Just to give you a little bit of a background, calls and puts, really, it's not going to matter too much when you're doing spreads. That's kind of the short answer. The issue really comes down to where there is an issue is when you get close to expiration week, because things are in the money. And when you're in the money, remember, those contracts have obligations, even if you're doing a spread. So anytime you're short one, you're going to be obligated. Overall profit and loss, not a big difference. Overall getting in and out, that could be a bigger issue. It could be a little bit of a problem, but overall it's not a big thing if you're trading liquid stocks. So let me give you a breakdown here. I'm going to go ahead and hide the current position. So if we do, like, let's say a 1900 call, let's just call it, let's do 1850 just because prices have moved. Let's say 1850. Here we'll do the calls and we'll do the same thing on the put side. Analyze trade, we'll do the puts. Okay, so you can see one is slightly different than the other. Okay, this one you're getting basically calls you're doing for about $28. Okay, so your max profit at this point is around $3,145, risking about $2,800. Okay, well, let's take a look at the put side. Okay, the put side, you're doing about $3,150, risking about $2,440. So, okay, so this one, the risk is $2,440 on the puts. On the calls, risk is $2,700. So a little bit more, $300-$400 more. The profit on the put side potential is around, max profit, around $3,000. And on the call side, around 3,100. So you can see they're very, very, very similar. Now, why is there kind of a big difference? Well, the big difference is when you're doing, let's say we do the 1850s. Okay, so here's our 1850. The big difference is that the put side is in the money. That's the big difference. Overall, you can see profit and loss is not that big of an issue. Yeah, it's minor. But keep in mind, the theta and all the other things go with it. So it's not like, hey, one is really better than the other just on the profitability side. Because look, if you look at this one right here, on the call side, we have a theta of 5.93. And of course, these are wiggling, 5.8. And this one's 5.47. So even though, it may cost less, one has maybe 20, 30 cents more theta here and there. So overall, it's not going to matter that much. Where it does matter, here's where it does matter. Where it does matter is the fact that this one, at the 1850, okay, this one is in the money if you're on the put side. And getting into things that are already in the money is a little tougher because they're traded a little bit less. That's one thing. The other thing is that because it's in the money, it actually has obligations. So when you go towards the end, it's not going to matter let's say you put this trade 40 days out. Nobody's going to, if they're buying these contracts to hold for 40 days, they're not going to execute their rights most of the time. I'm not saying it won't happen, but 99% of the time, it's not going to pan out to where you'll get assignment. But the issue happens is if you wait till, let's say, 5 days before expiration, well, you're going to have a much bigger problem with the ones that are in the money. whereas the ones out of the money will have less of a problem. So which one would I do? Which one would I go with? I typically like to stay out of the money, right? So that way I don't have contract problems. But in certain situations, you know, it may be fine if, let's say, you can't get filled, if you need to hedge, it may be fine to go in the money as well. So when would you go kind of in the money? Typically, it's kind of, I don't know. I mean, really tomato, tomato. In certain rare situations where you say, hey, I can't get filled, there's just more trade there, or maybe the stock's going to move in that way and really blow past it, you could go the other way. The other times when I do go in the money is sometimes when I have a ton of positions. Let's say, let's just take the call side. I have a ton of positions on the call side where it's just so confusing, and I want to put a few more really different positions. Let's say I'm doing like 25 different calendars on here, and they're all spread out amongst these. Well, to kind of manage it properly in the same account, if you want to do, let's say, a butterfly or a vertical to hedge, you might go in the money on the put side, just so that you know, hey, that one is the puts, even though I did it in the money, just to vary it up, because just to see all those contracts, it can get really confusing. And that's, of course, when you're trading a lot larger. So that's kind of some situations when you may want to go in the money. But otherwise, I mean, overall profitability wise, it's not much different. So you can see this one, you make 31.41. The other one, you can kind of make about 31.09. Right now, maybe the capital usage here, this one is 2,800 and this one is 2440. So there's a small difference, obviously, but again, the big issue and the big difference is getting in and out of the position, because if you're in the money, it's a little harder getting in and out, and of course, contract obligations. So if you're getting close to expirations, anything in the money, you're going to have a little bit of a problem with. So usually better to stay out of the money, but profitability wise, it doesn't matter that much. All right, so I hope that makes a little bit more sense for you and you get some insight. Thank you so much for sticking with me. Be sure to hit subscribe on YouTube so that way you get notified as I release new videos. And of course, join me on my newsletter list so that way you get notified as new discounts, promotions, and including our group webinars, discussions, coupon codes, all come out there. So get on the newsletter list. And if you have a question that you want answered, go to tradersfly.com, ask a question, and then you'll know. All right, thanks again, and I'll see you next time.